I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting.
Markets are completely ignoring Fed speakers right now. They don't want to hear it.
But I have an open mind about whether 75 is going to be necessary.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. No victory yet. The Fed's Mary Daly says cooling prices are welcome, but the fight against inflation is far from over. Contradiction. The UK economy shrinks for the first time since COVID as manufacturing and services drop. The readings are not as bad as feared. Plus, the U.S. Attorney General says he approved the search of Donald Trump's residence. The Washington Post says the FBI was looking for documents on nuclear weapons. Now, first thing is first, let's check in on the markets. Yesterday, we had a bit of a wobble after that inflation print the day before. The focus, of course, is on inflation, maybe moving away from inflation if markets believe that they've peaked. To look at the labor market. As long as the labor market is strong, what does that mean for Fed hikes? Today, we have the University of Michigan data, extremely important. I know it's Jim O'Neill's favorite one, and Jay Powell also mentioned it in the press conference. European stocks for the moment, 0.4% higher. S&P futures also higher. The 10-year yield. Of course, this is the big one when you look at anything to do with Fed hikes. And also, there is a clear belief in certain parts of the market that is equities and treasuries that are actually moving the Fed in the direction instead of the other way around. And then we had that GDP figure from the UK, 121.76. When you look at the European map, but one of the things that maybe is a bit more unusual, of course, it's liquidity because it's in August, but it's also, we have a great story looking at the Rhine River in Germany and the fact that because of the levels being so low, it's really at the limit of being able to be navigated. That will have huge implications for the economy as a whole. Now, the San Francisco Fed President, Mary Daly, says the cooler inflation reading for July may actually mean that a 50 basis point hike is, or at the central bank's September meeting, is what she wants. She also told Bloomberg that the fight against price pressures is far from over and policymakers must keep watching the data.
The scale 50-75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent. And so really how I think of whether it's going to be 50 or 75 is I look at a lot of things coming in. So we have inflation numbers coming in. We have employment numbers coming in. We actually spend a lot of time, I know I do and my colleagues do, talking to businesses, households, community groups, people in stores. What are you feeling? And are you seeing signs that the economy is slowing? So all of those things, when I put them together, global risks, global growth, I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to we see those things slow enough to say, wow, we've got the momentum we need to really fight inflation.
But 50 or 75 isn't about pivoting. It's not about ending this rate hike path. So I'm still kind of curious, if you just were looking at those numbers, what would you say? Do they support your baseline, for example?
Oh, the numbers we just got? The numbers we just got say that we have enough uncertainty about the path of inflation. It looks a little bit improvement, but we don't want to be head fake, so we want to wait for the next report. We have an inflation report and an employment report coming out before the next meeting. It really behooves us to stay data dependent and not call it. But for today, with those numbers in hand, I still think 50 basis points is the case, but I am open to 75.
San Francisco Fed President Mary Daly is speaking to Bloomberg TV, of course, about the outlook for rate hikes in September. Now, we're joined by Kallum Pickering, senior economist at Berenberg. Kallum, thank you for joining us. I have a million questions on inflation, what we're looking at in the U.S., and I know we also need to talk about companies and maybe margins. When you look at inflation, the markets are definitely leading what the Fed is thinking, right? Or at least they're trying to push the Fed. What's the direction of where they should go next? Labor market?
I would be more concerned about inflation expectations than labor markets. The problem with looking at near-term data is anything the Fed does in reaction to it is not going to change what happens over the next 2 months. It's going to change what happens in 2023. So I think the forward-looking data are much more important. In the case of the US, what you have is this very rapid nominal expansion. And even though there are some supply-side reasons why inflation is high. Actually, the Fed just needs to bring down this nominal pace of momentum. I think the best way to do that is to focus on inflation expectations, because what will happen is if inflation expectations keep coming down, then wage and price setting will be set in relation to that, and you should see that nominal path ease a little.
The problem is there a concern that they're a little bit of all over the place, and then again, because the market is trying to front run what the Fed does, that now they've basically settled on the fact that this has been peak inflation.
Well, I don't think we should take too much from this idea that the market is leading the Fed. Central banks nowadays like to use forward guidance to make sure that on the day they don't surprise markets. Let's not have any undue volatility during a recession. So it's no problem that the market is saying one thing and then the Fed is saying, well, the market's right. A lot of intelligent people in markets, right? They have a good idea of where rates should be. What would matter is if the market was forcing the Fed to be inconsistent with the data. So if the market is suggesting actually inflation is probably coming down, we're heading in the right direction, the Fed can ease up, I think that's absolutely fine. I think what I prefer from the Fed is actually that they sounded a little more hawkish. If the market wants 50 basis points, go for 75, really bring inflation expectations down, and then markets probably find some support into next year as discount rates come lower. At this point, I don't think the Fed avoids a recession, so just get the inflation out of the way, and then let's worry about what happens next.
So maybe even go for 100. I mean, is there a window of opportunity in September for the Fed to, beat hard and beat fast and get inflation under control?
Well, you can always bring inflation under control as a central bank if you go for a huge rate hike. 100 basis points is probably too much now that inflation may be heading in the right direction. 75 still feels about right. It's suitably hawkish. Yeah. It's kind of an insurance policy in case there are any inflation surprises in the next few data points, because the last thing the Fed wants to do is see that inflation may have peaked, start easing the pace of rate hikes, and then find out that it's not peaked, and then you need to just go back again, and then you get market volatility.
What does that mean for companies? I know you want to talk about margins, and this is basically whether you pass on some of the inflation to your customers, I get at the risk of losing them.
Well, I still see this big gap between what the market is telling us and has for a long time, that we're heading for a recession, and what companies are suggesting, which is actually, yes, well, things are a little bit uncertain, but we've got lots of pricing power. I think the margin squeeze in the second half of the year is going to be the big sign that the monetary tightening is working. There's a time inconsistency for companies. You decide you want to produce stuff, and then you go out and you sell it. So you'll hire, you'll bid up input prices, but then when you go to consumer, if you can't pass on that higher cost, then you're in trouble. But if central bank tightening is going to work, eventually they won't be able to pass on that cost. And so that margin squeeze has to come.
But we had a great chart, which I was trying to find, but I don't know if we have it at the moment, which is something that Mark Hudmer was telling us. And it's basically consumer prices in the U.S. also being held because people continue borrowing.
Yep. Right?
At that point, does it put us in a very sticky situation?
Well,
I think we have the charts. Hallelujah.
Here we go.
There it is. Beautiful chart.
There's no real problem with consumer credit per se. If consumers are borrowing because there's a temporary real income shock, that's consumption smoothing. You want that in a healthy economy. What you don't want is excessive borrowing to maintain an unsustainable rate of nominal GDP growth, which is what the US experiences. That's where the Fed steps in. If the Fed tightens, it can encourage more saving, it can disincentivize credit, and that will help bring that nominal pace of consumption down. So I wouldn't worry about the debt issue. I would worry about the problem that you have too much cash chasing too few goods.
But COVID distorts everything, Kallum. I mean, I have conversations with, my cab drivers every morning, and it's 3 holidays in the summer because of that pent-up demand.
Yep. Well, that's the distributional effect. So this is an unusual recession. This is not an economy which is ready for a cyclical downturn in the US or in Europe. It's been intercepted by a host of global headwinds. That means that the scale of the GDP drop, maybe around 2% in the US, close to that in the UK, probably around that in the Eurozone, is about half of what you would expect in a usual cyclical downturn. So if the recession is going to be half as bad as normal, you would expect actually parts of the economy to do just fine. Pent-up services demand maybe does okay. Durable goods probably suffers. Housing momentum probably suffers. Business investment, let's see. If it's the supply of stuff, capital goods, which is holding back businesses, and they anticipate strong demand during the recovery, you may actually see some business investment come through this recession.
Kallum, thank you so much. Kallum Pickering, their senior economist at Berenberg, stays with us, and we'll talk about the UK because a bank holiday hangover. Well, the UK economy contracts in the second quarter, in part due to this extra bank holiday for the Queen's Jubilee. We'll break down the data next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, it's UK GDP day. Economists were expecting a second quarter contraction. They were right. The UK economy contracted by 0.1% from the previous quarter. Now, Bloomberg Economics attributes the contraction to declining health output, softer retail spending, and the Queen's Platinum Jubilee, the extra bank holiday likely dragging on activity. Now, let's get more details from our Lizzie Burden. Lizzie, so if you walk us through the data, I love the fact, and this for our international audience is like, wait, what? You have a bank holiday, and this could actually just change us off kilter.
Well, it effectively turns a weekday into a weekend, but the impact of the bank holiday was less than expected because you still had people going to the pubs, going to hairdressers, so not as big of an impact as we thought. But you also had, as you say, the decline in health output because of the wind down of COVID test and trace and the vaccine. You had the hit to retail spending because of the cost of living crisis. And also, parallel to the GDP figures, you get the trade data. They showed because you had higher energy prices, it weighed on imports, which made the trade deficit the widest on record in the second quarter. Looking ahead, though, to the third quarter, Bloomberg Economics reckon you're going to get an upswing because of the absence of the bank holiday. So that means that we're not going to have 2 consecutive quarters of negative economic growth, which means for now we'll stave off the technical recession that the BOE is warning about that we'll get from the fourth quarter onwards.
So how does this all play into the Conservative leadership contest?
Well, this is the battleground. How do you deal with the double-digit, not just double-digit, but above 13% inflation that we're expecting in the fall? Those two candidates seem to be changing their positions slightly. Rishi Sunak now saying that he would scrap VAT on energy bills to make it easier for households to deal with them. Liz Truss saying she would be a bit more open to handouts, actually, as she put it. But really, Bloomberg Economics says that even though Liz Truss said a recession wasn't inevitable, it is still going to come. Even if she makes £40 billion worth of tax cuts, there's still going to be a 1.3% drop in economic output, even if the BOE had said it would be 2.1%.
I wonder whether Kallum knows that the price of a cheeseburger at McDonald's went up 20% because Lizzie had this wonderful package on social media. Actually, looking, I mean, even McDonald's, that cheeseburger was up 20%.
14 years they haven't raised the price of a cheeseburger, and now they've put it up 20%. Symbolic of inflation across the economy. Can you think of anything that hasn't risen in price?
That is essentially the issue. Typically, central banks would like to look through supply shocks. This is a huge supply shock, certainly on the energy side. But what you should observe in the underlying inflation data, if you look across the basket, is the supply shock affects the parts of the inflation basket that are in short supply. What we've actually had is people have to spend more on food and energy, but then they've continued to accelerate their spending on other goods. So we have this now broad-based inflation. You look at the consumer basket, more than 80% is growing above 3%. This is the problem. This is because monetary policy was too easy last year. This is the effect of a policy error.
I understand, but what could they have done? I know in hindsight is a beautiful thing, but even if they hiked in November where the market was pricing it in, would they just have given the Bank of England that 6 weeks advantage?
No, I think this is actually an important point here. To say that the Bank of England committed a policy error is not to say if they would have done something different at the time, it would have had a different. That's not. The point is when it comes to economic policy, there's an ex-ante, ex-post conflict that always arises if the data surprised you. So the Bank of England, in hindsight, did the right thing. They wouldn't have changed their policy, but the economy surprises.
If you think, I mean, the problem is that also there's a huge labour shortage, and that's more to do with Brexit.
No, again, I think these are kind of stories which are just amplified beyond what they need. You know, you're talking about a few 100,000 workers here. The labour force in the UK is almost 33 million. 1% of the labour market is not going to double your annual wage growth.
Right, but why do I speak to chief executive after chief executives that tell me that they can't have the staff? There's a skills staff mismatch.
Well, Brexit's not the explanation for the skills mismatch in Europe or in the US. What you have in the UK is record vacancies. What you have in the US is record vacancies. Same in major parts of Europe. We have had an economy after COVID which has actually surprised to the upside. It's almost as if the world returned to normal. Demand just returned to normal. Before COVID, we had lots of supply, but a persistent demand shortage. That's why growth was weak. Now what we have is almost normal levels of demand, but these supply problems. The reason monetary policy, why central banks got caught offside, is they didn't spot the underlying demand had returned to normal, and monetary policy was set too easy in 21.
Yeah, and this, again, that's a COVID effect, right? Because it kind of blurred everything, which is why we're talking about transitory?
It is, but...
Or is it a fault with the models?
No, it's not fault with the models. It's the fact is, for 10 years, the economy just consistently was weaker than expected. We had this chronic pessimism that basically fell out of the economy in 2021. People went out to spend, businesses wanted to invest. And central banks, after 10 years of under-forecasting inflation, said, let's really wait to see this problem before we react to it. And then the war arrived, and then you had the Chinese lockdowns, and now they're caught offside. I'm pretty happy with the underlying economy. We just have to get through these supply issues.
All right, thank you so much. Kallum Pickering, their senior economist at Berenberg, joining us on everything economics, and also our Lizzie Birding looking at UK GDP. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Bloomberg has been told President Joe Biden is getting ready to launch his re-election bid after November's congressional midterms. It sets up a potential 2024 rematch with Donald Trump. Polls suggest most Democrats would prefer a different candidate. Those close to Biden say he is committed to stopping Trump from returning to the Oval Office. Here in the UK, the front runner in the race to become the next Prime Minister has ruled out a new windfall tax on energy companies if she wins. Liz Truss has said doing so would send the wrong message to businesses, international investors and also the public. Her rival, the former Chancellor Rishi Sunak, is promising to find up to another £10 billion to help people pay for soaring energy bills. The Rhine River is set to drop well below a critical depth over the weekend. The fall could threaten energy shipments on one of Europe's most crucial waterways. German data suggests water levels at the Cave Waypoint west of Frankfurt are poised to plunge 33 centimetres by Monday. Most barges are unable to navigate the river when it's below the 40 centimetre mark. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, Trump's legal hurdles. The FBI searched his home for classified documents related to nuclear weapons. That's according to the reports from the Washington Post. We'll get more on that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the FBI searched Donald Trump's home to look for documents relating to nuclear weapons. That's according to reporting from the Washington Post. Trump says he supports the release of documents relating to the search. Meanwhile, U.S. Attorney General Merrick Garland says he did approve a decision to seek a search warrant for Trump's residence and is asking a judge to unseal the warrant.
I personally approved the decision to seek a search warrant in this matter. Second, the department does not take such a decision lightly.
Well, joining us for more is Bloomberg's Bruce Einhorn. Bruce, it's so secretive what they were actually looking for, who tipped them off, and what comes next. When do we find out the content of the warrant?
Well, we may find the contents of the warrant within the next few days. We just heard Attorney General Merrick Garland. He has issued a request to the court to unseal the warrant because the Attorney General, the Department of Justice, doesn't have the ability to release it itself. Former President Trump does have that ability. He has the warrant. He has the receipt, the list of items that were taken from his Mar-a-Lago home by the agents. He hasn't released it up until now. The former president has now released a statement saying that he does not object to the release of the warrant, and he is now encouraging it. So given that we now have both sides saying, yeah, let's see the warrant, we're likely to see it soon. One thing to keep in mind, the warrant may not have as much information as many people hope. There's another document, an affidavit that the FBI had to fill out and give to the court in order to get the warrant. That affidavit probably has a whole lot of detail about what it is they were looking for. We're not getting that affidavit. That's going to stay sealed.
Bruce, do you have any insight into what the warrant was for? Is it really nuclear weapons? I know for the moment, I think it's just Washington Post reporting. Is it about U.S. nuclear weapons? Is it, other countries' nuclear weapons? Like, what do we actually know?
Not much. We don't know much, unfortunately. We have the Washington Post reporting, citing people familiar, that agents were looking for, among other things, documents related to nuclear weapons, whether these were American nuclear weapons, foreign nuclear weapons, whether they got these documents, whether they took them when they left, we just don't know. It is significant for several reasons. Obviously, nuclear weapons, that focuses the mind. The other thing, of course, is that over the last few days, many defenders of the former president have criticized the Justice Department, saying, well, what was the urgency? Why did you need to have this kind of a raid? If it turns out that this is confirmed, the Washington Post report, and the documents were related to nuclear weapons, it might go a long way toward addressing those concerns by saying, look, these, something when it's about nuclear weapons, there is some urgency to the matter.
Bruce, thank you so much. Bruce Einhorn there with the very latest, of course, on Donald Trump. Coming up, we take a look at the Russian economy ahead of GDP data due later today. Sweeping sanctions are expected to have set output back 4 years in the first full quarter following the invasion of Ukraine. That story is up next, and this is Bloomberg. No victory yet. The Fed's Mary Daly says cooling prices are welcome, but the fight against inflation is far from over. Contraction. The UK economy shrinks for the first time since COVID as manufacturing and services drop, but the readings are not as bad as feared. Plus, the U.S. Attorney General says he approved the search of Donald Trump's residence. The Washington Post says the FBI was looking for documents on nuclear weapons. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, while pain at the pump for U.S. drivers is bad, for developing nations, surging prices can lead to strained finances, widespread misery, and political upheaval. Well, Bloomberg's Oliver Crook explains that the rising dollar and higher interest rates are proving to be a dangerous combination for emerging markets.
If inflation is a threat to the richest country in the world,
I believe that inflation is our top economic challenge right now.
For developing nations, it's a nightmare. Food prices were a principal cause of the Arab Spring, and today they're 20% higher. But it's not just inflation causing pain. It's the way policymakers are fighting it. The Fed is embarking on the most aggressive tightening cycle in a generation, and the entire financial market structure is shifting. For EM, two things are happening. One, the dollar is on a tear. Many nations borrow in dollars, and the burden of their debt is soaring. And two, rates have shot up. That hits the financially weakest first and hardest. Kenya, for example, scrapped plans to raise $1 billion in bonds. The cost of financing was too high. The ultimate fear for EM? Default. Sri Lanka defaulted earlier this year after an inflation crisis. The question for investors, who could be next? Bloomberg Economics estimates the most vulnerable are El Salvador, followed by Ghana, Egypt, Tunisia, Pakistan, and Kenya. For some governments, it's an impossible choice. Pay your debts or feed your people. Spending more to help cushion the blow of prices imperils solvency and threatens to dry up capital completely. And the alternative isn't much better. Massive economic pain, food shortages, and even revolt.
Bloomberg's Oliver Crook there on how surging inflation is affecting the world's emerging markets. Now, Russian GDP figures due out later. They're expected to show a dramatic contraction that follows sweeping sanctions imposed by some countries on the Russian economy in response to President Vladimir Putin's invasion of Ukraine. Now, we're joined by Magdalena Polan, principal economist at PIJ. Magdalena, thank you for joining us. Also, there's a school of thought that's saying actually the Russian economy has been able to weather some of the sanctions much better than we were expecting. What are you expecting for the Russian economy to do?
Good morning, Francine, and good morning, everyone. Yes, the Russian economy has defied the odds of some of the worst expectations for its performance, despite the harsh sanctions and limits on its exports. And we do expect the economy to absolutely feel the effects of those sanctions, but they are not as bad as they seemed initially because of the combination of factors. So there's been a deep contraction in domestic demand that led to a fall in consumption. However, at the same time, if you look at the statistics for GDP and growth, you can see that this contraction also led to a contraction of imports. And that means that the Russian net exports are actually performing much better than expected. And also the initial shock and the initial jump in inflation, and that's cost of living, but also interest rates, that was reversed quite quickly. And that's going to offset some of the economic pain for the Russian businesses and consumers.
Magdalena, how much of this is actually, I mean, not financial engineering, but actually it's a central bank that was very on top of it and that mitigated some of the concerns?
Well, that's kind of success of the past policies and the reforms of the Russian economy, that they do have a very credible, activist, skillful central bank that was able to quickly react to the situation and then reduce rates also very quickly. But also I think it's also a fact that commodity prices shot up so much that this helped to stabilize the Russian ruble so quickly that the central bank was able to react. So it's really a combo of that commodity price shock acting positively for Russia, negatively for the rest of the world, and then a rather credible central bank.
What happens in the next 2 years? So, by a very simplistic shock, if you have a full gas embargo from Russia, can they sell it to other parts of the world fairly quickly?
Yeah, so the things don't look that rosy. I think in the beginning, I think Russia will continue to defy these expectations and even look better than other countries because especially the Russian neighbors will suffer from possible shortages of gas and oil and the transition to other sources of energy and a disrupted supply chains. However, for Russia, things don't look that great. Russia does rely on imports, and especially consumption can be replaced. You can produce these consumer goods domestically, but capital goods that sustain investments, they have to be imported. And Russia is already looking for other sources, but can China or, say, India really replace the capital goods imported from Germany and the US? I think it's going to be very hard. So Russia, even before this, was already stuck in a relatively low growth path. If we look at where Russian GDP was before the takeover of Crimea and now, it's only maybe just about 10% above that level. And without access to Western technologies...
What does that mean? Yeah, I mean, the China-India part is extremely important, right? Because they seem to have absorbed a lot of the energy consumption that Russia lost because they used to sell to the EU. How much of that gap can they actually fill?
It's a very hard question to answer right now because we know from some of the statistics of imports of technology related for, say, oil exploration and gas, that a lot of this technology comes indeed from Western countries. So that is a hard gap to fill. In other parts of economy, that could be covered. But unfortunately for Russia, that means they really cannot really replace the technologies they are losing. So I think this doesn't bode well for medium-term growth for Russia. Obviously, these technologies can be developed elsewhere, but that takes time. So our views on the next few years are actually of a rather lackluster performance, an economy stuck in low growth, low inflation environment.
Magdalena, thank you so much for joining us. Magdalena Poland, there, a principal economist at PGIM, looking at the Russian economy and, of course, what we can expect from those GDP prices a little bit later on. Coming up, dried up water levels on the Rhine River are set to fall at a critical level that could upend the trade of fuels throughout Europe. More on that story next. And this is Bloomberg.
When U.S. inflation numbers are released,
a major drop in the headline number.
Bloomberg brings you crucial data at terminal speed.
Yields dramatically lower. Futures dramatically higher.
Strong rally. Bam. People are going full risk on.
And instant expert analysis.
At what point does the Fed signal we're done?
The market's not believing that the Fed has yet done enough. One report is not all it's going to take.
When do we get back to boring inflation?
Nobody covers the economy like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, the Rhine River is set to shrivel to a critical threshold that could actually upend the trade of fuels through Europe. The level of the Kallum waypoint is poised to fall below 40 centimeters and continue dropping in the coming days. Now, the effects of the decline may also ripple through the continent for months. Joining us to discuss about the consequences of all of this is Bloomberg's oil products and shipping reporter. He is Jack Whittles. Jack, great to have you. I mean, a lot of people have suddenly clocked to the fact that you need these rivers to transport things. So at what level are we? Is it really critical? And if it dries up, what does it mean?
Right, so just to explain, so the Rhine, it runs from high in the Swiss Alps, about 800 miles all the way down to the North Sea. And that is used to transport all sorts of goods, oil products, but also commodities, so iron ore, coal, gravel, sand. And so at Kallum, the latest, I just looked on the terminal, the latest was 41 centimetres.
Right.
When it gets to 40...
That's a water level.
It's a measure of the water level.
Water,
it's not the water level is literally a bit deeper than that. But when it gets to 40, it becomes uneconomical for a lot of barges to carry goods through there.
Why uneconomical? Because they have to use more power to get through the water?
It's more like the more you load into a barge, the lower it sits in the water.
Right.
And so the deeper the barge gets in the water, then when you've got shallow water, if you load too much, it will scrape along the bottom. So shallow water means you have to reduce the amount you carry in a barge. So it's not a hard and fast thing. Like, there are some barges that will still be able to get through when it hits 40, which it is supposed to do later today. But it is, and Kallum is just one place on the Rhine.
Right.
But all along the Rhine, obviously, the river levels are low.
It's a good barometer. So, Jack, at some point, does it become impassable? And does it become impassable this summer because it's just not economically viable, or because ships can actually get through?
I think one owner said to me he had ships that could get through at Kallum 20. So that's when it gets to 20 centimetres. But I think that's a small number of ships. So, and, you know, if it got below Kallum 20, I imagine then maybe at some point there would be a complete halt. My understanding is that it is up to individual owners. It's not like the German government comes in and says the river is now closed.
Interesting. Thank you so much. I mean, we've all become like Rhine River experts in the last 2 days as one of the biggest concerns facing our economies. Jack Whittle there from Bloomberg. Now, for more on the climate around Europe, we're joined by Liz Bentley, Chief Executive of the Royal Meteorological Society. Liz, great to have you on the program. What can you tell us about what all of this climate change and rivers drying means going forward? Will it just get worse?
Yeah, so if we look at climate projections that take us forward decades, you know, we're expecting more frequent heat waves. When they happen, they're going to be more prolonged, they're going to be more intense. And then we obviously see linked to that these drought conditions as well. So we'll see an increase in the number of droughts, particularly during summertime droughts, and then becoming more prolonged. And then obviously an increase in wildfires because of that. This is already playing out across, you know, most of Europe. So on Wednesday this week, a European body announced that 63% of land area across Europe was under drought warnings. 63%. Right. That's equivalent to the states of California, Texas, and Alaska combined. So a huge area.
But Liz, so how do you match up sea levels actually rising around the UK, but rivers drying up?
Yeah, so sea levels are rising partly because ice is melting and flowing into the sea, and that causes it to rise. But the temperature in the ocean is also increasing. So you get thermal expansion. It takes up more volume because it's a higher temperature. But because of the drought, because of the lack of rainfall, because of the extreme heat and all that extra evaporation of moisture out of the land, the rivers and the reservoirs into the atmosphere, that's causing the land to dry out much more. And those rivers, as we've just heard on the Rhine, a number of rivers across Europe are really struggling. And here in the UK, we're struggling as well as those river levels drop, not just for moving goods around, but for ecology and the fish and so forth that live in those rivers are now really being tested. You know, it's a real difficult time.
Liz, if you look at water companies, are they to blame actually for some of the climate changes that we're seeing in the UK? I think there's a media report suggesting that you also have seen some of the biggest rainfall that we've seen in the UK in the last 15 years. So again, how do you make sense of all of this?
Yeah, so I think there have been some improvements in water management, particularly here in the UK. I think there have, if we go back over a few decades, we've seen improvements, but there still are improvements to be made. So there's about 12% of water is just leaked out of pipes. And I think the water companies have to do, some major work to improve on that number. And I think as well, we do get a lot of rainfall in the UK. So over a typical year, we have enough rainfall. It's about how we manage it so that when we have surplus, particularly in the winter time, we can store that and use that when we have these periods of drought that we're seeing at the moment. And we also have spatially, so the northwest of the UK tends to be wetter. It has more rainfall than the southeast. And so we need to think about how we can transfer water from one place to another where there's a surplus to a place where there's a deficit.
Liz, it's pretty incredible to think that this is just water leaking, and so it could be fixed quite quickly. Why has that not been fixed? Expensive?
I think it is, and I think the water companies have been set some targets, and they do make progress. But as I say, 12% of our water just leaks out of pipes. And clearly there has to be improvements to be made. If I put that into context, when these hose pipe bans come in from companies, so us as humans, gardeners, we can't use the hose pipe to water the garden, clean the car. That just saves 5% of water. So, if we could sort those leakages out, we may actually avoid these kind of water restrictions and hose pipe bans.
All right, Liz, thank you so much. Liz Bentley, their Chief Executive of the Royal Meteorological Society, joining us this morning. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Apple has asked suppliers to build at least as many of its next-generation iPhones this year as in 2021. That is despite worsening projections for the smartphone market. Sources say Apple's asking assemblers to make 90 million of its newest devices in a bet on affluent buyers and dwindling competition. Now, South Korea's president has cleared the heir to the country's biggest company of bribery charges. The move gives Samsung Electronics Vice Chairman Jay Wiley the right to work at the firm. Lee spent 18 months in prison before his release on parole a year ago. And Ping An Insurance appears to be unconvinced by HSBC's arguments against a proposed spin-off of its Asia operations. A source says the Chinese insurer believes the lender is in need of urgent and radical change. Ping An is HSBC's largest shareholder. The source estimates a spin-off would generate additional market value of $25 to $35 billion and also reduce costs. Sales from electric vehicle maker Rivian rose $364 million in the second quarter, well above analyst expectations. Rivian lowered its earning guidance, however, the company saying it now expects to make a full-year loss of almost $5.5 billion. In a statement, Rivian blames ongoing supply chain constraints for limiting production. Johnson & Johnson will change the way it produces baby powder, making all its products based on cornstarch. The transition comes amid legal action surrounding its talc-based baby powders, with some consumers are claiming it made them sick. Johnson & Johnson is standing by the safety of its talc-based products, saying they do not contain asbestos and do not cause cancer. The SEC is reportedly looking into Malvern Capital Management's risk controls and investor disclosure after it was crippled by last year's meme stock rally. According to the Wall Street Journal, the SEC has contacted the hedge fund's investors. It's part of an investigation into whether they were misled last year when Malvern raised money. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Leanne Gerrans. Now coming up, but no victory yet. The Fed's Mary Daly says cooling prices are welcome, but the fight against inflation is far from over. We'll wrap up the market action next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting some breaking news of China Life planning to delist some of their depository shares from the New York Stock Exchange. Now, this is according to statements on the Hong Kong Stock Exchange. We had seen, of course, the U.S. trying to push the delisting of some of the Chinese companies. Also, the message from Beijing was very clearly, guys, let's not try and have too much exposure to the U.S. Let's delist. I think it's one of the big ones, the China Life Insurance, again, in the long last couple of minutes saying that from the 25th, or because of, by August 22nd, actually, they will delist its ADSs from the New York Stock Exchange. Now, back on to inflation and the fight against it. San Francisco Fed President Mary Daly says the cooler inflation reading for July may mean a 50 basis point hike at the central bank's September meeting.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to, we see those things slow enough to say, wow, we've got the momentum we need.
Well, joining us now is Bloomberg's Justina Lee. Justina, I have a million questions on actually how the markets reacted yesterday, which is a little bit odd. I guess I don't know whether they're now focusing on just like how hot the economy is to figure out what the Fed does next.
Right, exactly, because obviously initially we had a big relief rally on the back of those CPI numbers, and then yesterday markets got a bit more nervous again. I think maybe they are worried about the Fed officials not actually kind of easing their inflation worries as much as maybe investors have. But on the inflation front, we did get more good news yesterday with producer prices actually falling for the first time in 2 years.
So what data point are you looking at next? There's University of Michigan today. I'm quite excited. I think it's Jim O'Neill's favorite data points, and also Jay Powell mentioned it.
Yeah, and I think, apart from that, I think the key question for inflation right now is the labor market.
Yeah.
I mean, yesterday we did see initial jobless claims climb a little bit, which usually is a bad sign, but in this case could be a sign that heat is coming off the labor market a little bit, and job openings have also come down as well. And so if those trends kind of persist, I think markets would be breathing a collective sigh of relief that maybe Fed can do that as well.
Justina, do you feel like the market are really pushing the Fed in a corner?
Yeah, I mean, that's an interesting question because we kind of have seen, market pricing for Fed expectations kind of coming down a little bit. Earlier, everyone was concerned about a 75 basis point rate hike, next month. But right now, they're kind of like mixed between 50 or 75. But we have seen Fed officials come out, all of them, in the last few days, reminding people that the fight against inflation is not over. And I think the key takeaway from that is that they're not, just going to base a decision on this month alone. They kind of want to see inflation kind of consistently come down across a few months.
Yeah, and I guess the trend, even if you see a trend, it doesn't mean it gets to like 4, 5, 2%, right? So it'll take hikes to take it down to the level of where they want it, inflation.
Yeah, and even with CPI kind of better than expected, there were still sort of points of worries within that report. For instance, rental prices are still very high, and kind of in the services sector, it seems like wages are still quite elevated, and that part of the labor market is still very tight. And so I think, the Fed would be happy. They're clearly happy, but they're still in a wait-and-see mode.
Yeah, and then, of course, Jackson Hole, that all-important Jackson Hole, even more important than previous years from August 25th. Justina, as always, thank you so much for joining us. Justina Lee with the very latest on the markets. All right, it looks like a concerted effort because minutes ago we were saying that China Life was intending to file a form to delist their depository receipts from the New York Stock Exchange. PetroChina, moments ago, literally 2 seconds ago, also saying they plan to delist their depository shares from the New York Stock Exchange. So I think that's coming pretty soon, about August 22nd. Of course, this is a request, I think, from the China side, but also probably from the U.S. side, as the two sides are not seeing eye to eye after Nancy Pelosi also visit to Taiwan. So maybe this has been accelerated because of that. I'm not 100% sure, so we'll delve deeper into that and bring you the very latest. And Bloomberg Surveillance Early Edition continues in the next hour. They'll definitely have more insight on this with Matt Miller, Kailey Leinz, and Tom McKenzie. This is Bloomberg.
The scale 50-75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent.
When we look at other measures of inflation, there's still a lot of work for the Fed to do.
We will see the Fed, achieve their objective over time.
Markets are completely ignoring Fed speakers right now. They don't want to hear it.
I don't really care what the Fed's going to do because the Fed isn't driving this ship.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. San Francisco Fed President Mary Daly tells Bloomberg cooling inflation is welcome, but the fight against high prices is far from over. Daly sees a 0.5 percentage point rate hike next month. President Biden prepares to run for re-election in 2024. Meanwhile, the FBI reportedly searched former President Trump's home for classified documents linked to nuclear weapons. And the shrinking Rhine River, one of Europe's crucial waterways, is set to become virtually impassable at a key waypoint today. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie here in London with Matt Miller and Kailey Leinz, of course, in New York. Anna Edwards is off today. And Kailey, the market's continuing, of course, to digest inflation numbers. PPA came in softer. You had the likes of JP Morgan saying, buy these equities.
Yeah, and a lot of people are, Tom. That has been really the story of the last week since that payrolls report on Friday. And the cooler inflation data, I say cooler, not necessarily cool, because objectively prices are still quite hot. But all of that leading to an up week or an upward end to the week in Asia overnight. The MSCI Asia Pacific Index was higher to the tune of about 0.6%. Actually, an outperformer was Japan, which had been closed for a holiday. So playing a little bit of that catch-up trade, the Nikkei 225 was up about 2.6%. Some of the outperformers in Japan and also really just in Asia overall were Apple suppliers after a Bloomberg scoop yesterday that Apple has asked its suppliers to make at least as many next generation iPhones this year as it did in 2021. So that signals some confidence on the part of the company that iPhone sales are going to be resilient even in the face of a slowing smartphone market. So one of those examples, TDK Corp was up nearly 5% in the Japanese session. Finally, have to keep an eye on the bond market as well because of course we saw a big move in the long end yesterday, yields moving higher after weak demand for that 30-year Treasury auction. And you saw a lot of movement in duration in Australia overnight as well. That 10-year yield up 14 basis points on the day, Matt.
All right, very interesting stuff. And we had a really interesting session yesterday in the cash trade here in the U.S. We were up pretty big, and then we turned down by the end of the session. Now we have futures back up again, right now about 0.5%, as the 10-year yield comes down 1.5 basis points. So investors are looking to bid up S&P futures, but also buying bonds right now, maybe for perceived safety there. NYMEX crude is really unchanged, but at 94.09, we've gotten well above the $90 range that we were hovering around for quite a long time. And Bitcoin, which was pushing 25,000 yesterday, is now back down at 23,947. So some conflicting data points here, although we're still a solid 4.5 hours away from the U.S. Open. Tom, what do you see in terms of Europe?
Yeah, Matt, some early trepidation at the start of the Open here in Europe, but a little bit more optimism has come through across these markets. You're seeing gains of about 0.5% here in the UK, the FTSE 100. Over in France, gains of 0.3%. Germany is up by 0.5. We continue to watch Italy, of course. You're expecting more political machinations this weekend as that infighting, or at least the plans and the discussions around forming a new government unfold over the weekend. Gains of 0.4% across the FTSE MIB. Let's switch it on. I want to look at the currencies as well, euro, dollar and the pound. It's worth noting we got the first quarter GDP print out for the UK. It actually came in better than expected. It was a drop, a contraction of 0.1%, not as bad as had been expected, though. Bloomberg Intelligence and Economics says there is still a very strong likelihood of a recession here in the UK. Broadly then, across the benchmark, gains of 0.3%, euro dollar 121, down 0.3%. The MLive team saying this could come under further pressure, the single currency, on the back of course, what we're seeing in terms of energy, that crisis around the Rhine, and then the politics of Italy. Euro dollar currently at 102, I should say. This is sterling I pointed to. 121 on sterling, down 0.3%. The single currency down 0.2%. And GSK, one interesting corporate story. We saw the fallout yesterday, the pressure on the stocks of GSK, Sanofi and others, Hewin, around this antacid drug and some legislation, at least legal cases. GSK saying they face, and they are named in about 3,000 of these cases, but they will fight them very, very strongly. We heard that from GSK earlier, gaining 3.5%, so making up for some of the losses that we saw yesterday. Kailey.
Yeah, the Zantac drama one we will continue to watch, Tom. Of course, it has been a very long week. It's not over yet. So let's take a look at what is ahead on this Friday. The Inflation Reduction Act is expected to win final passage with a House vote. Of course, it already has been approved by the Senate. On the economic side, we'll get Russian GDP data at 12 p.m. New York time. And here in the U.S., some data of our own, including the University of Michigan Consumer Sentiment Index at 10 a.m. Matt, those inflation expectations within that going to be closely watched by the Federal Reserve.
Yeah, absolutely. And maybe even more closely by the market. San Francisco Fed President Mary Daly says the cooler inflation reading for July was welcome, but she's not claiming victory yet. She spoke with Bloomberg's Kathleen Hayes.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary.
Bloomberg economy reporter Michelle Jamrisco joins us now for more. And Michelle, I mean, could we just add Mary Daly to one more Fed speaker that the market is going to ignore for now?
Well, that's right, Matt. And it's not the first time even this year that the Fed and the markets are talking past each other. And this is just a Rorschach test where everyone is just seeing what they want to see in this data. So the more complicated issue here, though, is that they seem to be disagreeing on multiple fronts. They're disagreeing about whether recession is imminent. They're disagreeing about the pace of the rate cuts or the rate hikes. And they're disagreeing about whether the Fed is going to need to pivot to those rate cuts sometime early 2023. Of course, you saw the softening, as you mentioned, the CPI and the PPI data immediately after that CPI release. Of course, let's remind everyone, it's the year-on-year rate is still at 8.5%, which is leagues above where the Fed wants it to be at 2%. We did hear then Neil Kashkari, Chicago's Charles Evans, and now San Francisco's Mary Daly, all kind of trying to tamp down that excitement in markets. So far to no avail.
Of course, we're currently looking at top end 2.5%. The dot plot's pointing to 3.4% by the end of the year. Do these comments from Daly, do the comments that we heard from Neil Kashkari yesterday inform or readjust how we look at the end rate for rates when it comes to end of 2022?
Well, it's interesting, Tom. I mean, I think Mary Daly was a touch less hawkish than perhaps Kashkari and Evans were the day previous or hours previous. I think she was talking more about slowing the pace of rate increases, but also all three of them pushing hard against this notion that their inflation fight is even close to being over. Mary Daly is saying, this is, of course, she said she likes to say the Fed is not data dependent, or they're data dependent, not data point dependent. So, of course, we're going to get more key critical reports in the weeks to come. We have PCE, the Fed's favorite gauge of inflation, coming end of August. And then, of course, the big jobs report at the start of September. Two occasions that I'm sure you'll see, again, the markets perhaps reacting in a different way than the Fed officials want to keep this strategy intact. But they are, continuing to say, Mary Daly saying that 50 basis points is her base case for September. Mm-hmm. We've heard bigger rate hikes from others, including Kashkari, Bowman, and perhaps Bullard on the Fed. And I would just point one more thing from the Mary Daly interview that I thought was a key highlight. She talked about the integrity, the indignity of inflation. So the grocery shoppers that are having to put items back on the shelves because they can't afford them. I think that really highlights, from a dove like Mary Daly, this kind of concerted effort from the Fed to fight inflation.
Yep, and they want to do it for the American people. Bloomberg's Michelle Jamrisco, thank you so much. And we'll have more this hour from our interview with San Francisco Fed President Mary Daly, so stay tuned for that. Meanwhile, in politics, the FBI's search of former President Trump's Florida home reportedly included a hunt for classified documents related to nuclear weapons. According to the Washington Post, it is not clear if any such material was recovered. We heard from the U.S. Attorney General Merrick Garland yesterday on the subject. Take a listen to what he had to say.
I personally approved the decision to seek a search warrant in this matter. Second, the department does not take such a decision lightly.
So he doesn't take it lightly. He also would like the FBI to release documents related to the search. Emily Wilkins, Bloomberg government reporter, joins us now from D.C. for the details. So not just Merrick Garland wants that, Emily. The former president says, do it.
Yes, we did see former President Donald Trump post on his social media network Truth Social last night that he is encouraging the federal court to unseal those documents. Trump does need to give his approval for those documents to be seen. Of course, Trump could also just put out the search warrant. He has it right now. He's able to release it. He hasn't yet. So we're going to be keeping a close eye on exactly what happens with that. At the same point, really major reporting here by the Washington Post that these documents could pertain to the nuclear weapons. Of course, it's not clear at this point whether that's the U.S.'s nuclear weapons, other countries' nuclear weapons. But this is really, Kailey, at the height of sort of classified material in the White House, and that someone could have. There are really strong repercussions for potentially taking that material out of the White House and for mishandling classified information. We saw during the Trump presidency a lot of reporting about his mishandling of information that's supposed to be classified, getting into the hands of folks who shouldn't have had it, not being disposed of properly, handled properly, recorded properly. So we know that this was sort of an ongoing problem for the former president. I think the question now is really what exactly did he take from the White House and what was his reason for taking that?
This search and the deep state conspiracy theories surrounding it really giving his base a boost, Trump's base a boost. And that, we hear, is leading President Biden to really look into another term, right? Looking to run again, even though he's 79.
Yeah, Biden has said repeatedly that he will seek a second term as president, despite the fact that that term would begin when he's 83 years old. But Biden has said that he's really the one who can beat Trump if Trump is to run again in 2024. And we've seen reports indicating that he will. Of course, he hasn't announced anything yet. But Biden sees that he's going to be the one able to beat him. But this really sort of ignores the reality that a lot of Democratic voters want to see someone new. A CNN poll that was conducted in late July showed that 3/4 of Democrat and likely Democratic voters want to see someone new nominated in 2024. Biden's own approval rating has been low for about a year now, hovering around 40-30%. And you've even heard some Democratic lawmakers saying it's time for someone new. So I think a lot of questions there. And of course, the other key thing to keep in mind, Matt, and this is really true for anyone who's in a position of power, the second you announce that you will be retiring or that you won't be running again, you lose a certain amount of power that you have in Washington. And so you have to think, to a certain extent, when you're thinking about how Biden is seeing things, it is only to his advantage to project that he's going to be around for a second term.
OK, Emily Wilkins of Bloomberg Government on that planning by Joe Biden for 2024. Of course, the latest in terms of those comments from Merrick Garland on that FBI raid. Now, the UK economy shrank in the second quarter for the first time since the pandemic. This was driven by a decline in spending by households here and also fighting the coronavirus. That spending gave up some gains as well. Let's get more then with Bloomberg's Lizzie Burden, who's been looking at all this data for us, the implications, the outlook for the economy. What stood out for you, Lizzie?
Well, this was almost in line with expectations, slightly better, a 0.1% contraction instead of 0.2. What drove it? Well, you had the cost of living crisis biting into retail spending. You had the bank holiday effectively turning a weekday into a weekend. You had health output declining because of the wind down of COVID programs. And because energy prices were up, it weighed on imports. And now the trade deficit is at its widest on record in the second quarter. Looking ahead to the third quarter, Bloomberg Economics reckon that you'll get an upswing because of the absence of the bank holiday. So it's a technical quirk that means the UK, for now, is staving off a technical recession. But really, for me, this data marks the start of stagflation in the UK. You've already had the Bank of England forecasting 5 quarters of negative growth from the fourth quarter.
In terms of what we're looking for to follow, are we going to see a recession?
Well, Liz Truss, the front runner to be the next Prime Minister, says no. She says that her £40 billion worth of tax cuts can stave off a recession, Matt. But actually, analysis by Bloomberg Economics says that isn't the case. There's still going to be a 1.3% drop in the economic growth of the UK compared to the 2.1% that the Bank of England forecasts. So overly optimistic from Liz Truss, says Bloomberg Economics.
All right, Lizzie, thanks very much. Bloomberg's Lizzie Burden talking to us about the shrinking UK economy. Let's talk about the shrinking Rhine River right now, set to dry up to a crucial level, which could impact the trade of fuels throughout Europe. The crisis is placing more reliance on rail and road transports, but they're just not set up for this sort of thing. Joining us now for the latest is Bloomberg energy reporter Anna Shuryevskaya. So, Anna, what do we know? The Rhine is set to be just about 15 inches deep today.
Yes, indeed, the water marker at key point at Kallum in Germany will drop to just 40 centimeters today. That will make it not economical for most barges to transit the river. That's the level of navigability, not the actual depth of the river, but still that means higher reliance on smaller barges that can navigate shallow waters. And indeed, as you said, Matt, more lines on rail and trucks to transport anything from commodities to goods. And what's more, this level will drop further to just 33 centimeters on Monday, at the lowest since at least 2007. And Uniper has already said that coal that's being transported by rail now will not be sufficient to run its coal plants at full capacity. And chemical giant BASF said that it may resort to production curbs in coming weeks if the situation remains aggravated.
All right, a climate crisis exacerbating an energy crisis. Bloomberg's Anna Shuryevskaya, thank you so much. Now, in corporate news, Apple has asked suppliers to build at least as many of its next-generation iPhones this year as in 2021. That's despite worsening projections for the smartphone market. Sources say Apple's asking assemblers to make 90 million of its newest devices in a bet on affluent buyers and dwindling competition. So let's take a check now on how Apple is performing in pre-market trading. It is positive, but not too large a move. Right now, the stock is up just 1/3 of 1%. It is a much larger move for some companies reporting earnings, including Toast. This is the restaurant software company. You can pay your bill on your phone. I don't know about you guys. I'm pretty tired of doing everything on my phone and those QR codes. I just want to hold a menu in my hand. But anyway, it's working out for Toast. They lifted their revenue guidance, so that stock is up about 20% before the bell. But plunging to the downside is Illumina. It's a DNA sequencing company. It lowered its profit outlook for the year, in part because it's expecting hefty fines from European regulators for going through with its acquisition for Grail. And as a result, that stock is down 15.5% before the bell top.
Kelly, I get you on that menu picture. In China, it was QR codes everywhere. You have to scan the QR code. You can't get hold of a menu. Coming up, Sarah Hewin, Chief Economist for Americas and Europe at Standard Chartered. We're going to be talking about and getting a preview of that University of Michigan survey, of course, and how that all plays in to Fed thinking. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller, Kailey Leinz here in New York. Tom McKenzie with us out of London. I am looking at the shrinking yield premium on the S&P 500. And I love this concept that you compare the earnings yield on an index to the dividend yield of risk-free treasuries. Investors are now willing to accept less than 2%. Ven Ram joins us from Bloomberg Markets Live to talk about why. Ven, why are investors willing to accept so little to buy stocks over risk-free bonds?
Because I think they are intoxicated by the summer heat that we have seen, Matt. That would be my guess. Why they would accept such paltry risk compensation is beyond me, because by the end of the year, the Fed funds rate is going to be somewhere between 3.50 and 4. And in that environment, do you want to be owning NASDAQ 100 that is offering a prospective earnings yield of just 4.1%? So that is, we are talking of a cushion of 60 basis points. So you're basically saying that, look, I would take the treasury yield at 350 or thereabouts, and I would take the earnings yield on NASDAQ at 410, and underwriting all the risk that comes with owning a stock. Companies could go bankrupt. The treasury is not going to go bankrupt. They're going to return the money. So for the risk that you're underwriting of owning stocks, are you willing to take so little compensation in return? That doesn't make any sense. And I think that there will be a reality check at some point.
All right, so we brace for that reality check. How does the rising real yield, particularly at the front end, play into that? Do you see those yields edging up further from here?
Definitely. I think that, Tom, real yields are going to go higher because that's the market's way of saying, yes, we have confidence in the Fed beginning to kind of get its hands around on inflation. And if really try to keep going higher, that will act as a drag on equity valuations. And sooner or later, equities will have to come face to face with it. At the moment, we are all in the summer hubris, shall we say, and the markets are glossing over the reality.
Summer hubris, the title of your piece. Mr. Market handing out roses. Thank you, Ven Ram of Bloomberg Markets Live. Check that out on the terminal, of course. And for more market analysis, go to M Live. Go on your terminal. Stay with us for now. This is Bloomberg.
You up to date with news from around the world? Here's the first word. Ukraine's ambassador to Washington is cautioning the U.S. and its allies against fatigue over a war that's costing billions in security assistance. Oksana Marakova told Bloomberg that it would be far costlier in the end to let Vladimir Putin go unchallenged. She says that if he isn't stopped in Ukraine, he'll attack other countries in Europe. The way has been cleared for Samsung Vice Chairman J.Y. Lee to formally take the helm of the electronics conglomerate. South Korea's president cleared him of bribery charges. Lee spent 18 months in prison before his release on parole a year ago. And in the UK, Conservative leadership frontrunner Liz Truss has ruled out a new windfall tax on energy companies if she becomes Prime Minister. Truss says it sends the wrong message to investors. Meanwhile, her opponent Rishi Sunak is open to the idea. He is promising to find up to another $12 billion to help Britons pay for soaring power bills. So coming up, we'll talk further about the UK economy after it fell into contraction in the second quarter, as well as the cooler inflation data we have gotten here in the U.S. this week and what it means for the Federal Reserve. Sarah Hewin, chief economist for the Americas and Europe at Standard Chartered, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know this Friday. San Francisco Fed President Mary Daly tells Bloomberg that cooling inflation is welcome, but the fight against high prices is far from over. Daly sees a 0.5 percentage point rate hike next month. President Biden prepares to run for re-election in 2024. Meanwhile, the FBI reportedly searched former President Trump's home for classified documents linked to nuclear weapons. And the shrinking Rhine River, one of Europe's crucial waterways, is set to become virtually impassable at a key waypoint today. I'm Tom McKenzie in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. Matt, what is your focus?
Well, I mean, we had such an amazing day of trading yesterday, right? We were up big for a second day in a row, and then we turned down to finish the session. Now we're looking at gains on the S&P futures, but we have some conflicting signals here. So S&P futures are up 0.5%, but investors are also buying 10-year debt. That pushes the yield down, not by too much, not even 1 basis point right now, but to 288.03. NYMEX crude is coming up. That would be a headwind, although it's a very light breeze here at 24 cents a barrel, up to 94.60. And then Bitcoin, which is normally positively correlated with risk assets, is actually down right now. I will point out that it's still over 24,000, and we were pushing up to 25 yesterday. Nonetheless, investors are selling that. So there are some conflicting signals here. Kailey, what do you see in terms of the actual pre-market movers?
Well, I'm focused on cars, or really EV makers, because you had one of them, Rivian, reporting after the bell yesterday. Disappointment when it comes to its EBITDA outlook. It's going to be a bigger loss than expected. So even though they kept that production guidance steady, the stock is down. Oh, it actually has flipped in positive territory.
Wow.
I stand corrected, 1.5% higher on the day. And it also, you're seeing some other EV makers like Lucid Group and Tesla each up a little bit more than 1% as well. The other story worth following is Apple. Not a massive move on the stock. It's only up about 0.3%, but a Bloomberg scoop overnight that the company is telling its suppliers to make at least as many next generation iPhones this year as in 2021. So that sends a pretty positive signal about the company's confidence that it will be able to withstand a slowdown in the smartphone market, and people are still going to be demanding those iPhones, Tom.
Yeah, Kailey, we're seeing gains here in Europe of about 0.2% in the session so far. When it comes to the UK, we had the latest quarterly printout GDP. It came in at a contraction of 0.1%, but it was less bad than feared. Bloomberg Economics saying, though, that there are still multiple challenges ahead, notably that energy price cap for households coming towards the end of the year. The pound currently down 0.5%, trading at 121. The single currency as well, euro dollar, interesting, a number of factors. The supply chain constraints across the Eurozone just being putting back into focus with what we're seeing in terms of that Rhine River and the drop in water levels, but also the politics of Italy are going to be focused this weekend. Currently weakness about 0.2% on the single currency, trading at 1.03. GSK, really the corporate story that we saw in focus, along with other healthcare and drug companies yesterday, making up for some of the very heavy losses. They came out and said they're going to fight very vigorously these lawsuits stateside around Zantac, of course, that antacid drug, currently up 4% in the session. Kailey.
Well, Tom, speaking of fighting vigorously, we've heard from a chorus of Federal Reserve officials that they still intend to vigorously fight inflation. San Francisco Fed President Mary Daly is one of them. She says the cooler inflation reading for July may mean a 50 basis point hike at the central bank's September meeting, but she told Bloomberg that the fight against price pressures is far from over and policymakers must keep watching the data.
The scale 50-75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent. And so really how I think of whether it's going to be 50 or 75 is I look at a lot of things coming in. So we have inflation numbers coming in, we have employment numbers coming in. We actually spend a lot of time, I know I do and my colleagues do, talking to businesses, households, community groups, people in stores. What are you feeling? And are you seeing signs that the economy is slowing? So all of those things, when I put them together, global risks, global growth, I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to we see those things slow enough to say, wow, we've got the momentum we need to really fight inflation.
But 50 or 75 isn't about pivoting. It's not about ending this rate hike path. So I'm still kind of curious, if you just were looking at those numbers, what would you say? Do they support your baseline, for example?
So 50 or 75?
Yeah.
I think 50 supports the baseline. Think about where we need to be at the end of the year.
I mean, the numbers we just got.
Oh, the numbers we just got? The numbers we just got say that we have enough uncertainty about the path of inflation. It looks a little bit improvement, but we don't want to be head fake, so we want to wait for the next report. We have an inflation report and an employment report coming out before the next meeting. It really behooves us to stay data dependent and not call it. But for today, with those numbers in hand, I still think 50 basis points is the case, but I am open to 75 should the data evolve differently.
So we've got another inflation report and another jobs report.
We do,
really
indeed.
Big wins. Now, I want to ask you, I want to hit some of the big points first. And the other one is there's, in terms of recession and recession risk, there seems to be frequently a sense in markets that, oh, once there's signs of a recession, if the risks are rising, the Fed will pull back. So is the Fed, are you willing to let those risks materialize if you have to risk a recession, if that's what it in the end takes to get the inflation rate down?
Well, I'd like to start with this. We are a long way from evaluating those risks right now. Look at the employment report. The people in the labor market, whether they're a firm trying to find a worker or workers trying to find a job, do not feel like it's a recession. Right now, jobs are plentiful. The main marker for consumers about a recession is, are they finding a hard time finding jobs? Is it hard to get a job? And are their incomes falling? And you really don't see that right now. So I don't see the risks of inflation as our preeminent risk. I see the most important risk we face in the economy as inflation is too high and has been too high for too long, and we need to bring that down. So when I'm balancing the risks, I'm really balancing how quickly can we bring inflation down without tipping the labor market over, and that's why 50 basis points makes sense to me right now.
Mary, does the stock market bullishness right now, is that challenging to the Federal Reserve, given that, of course, that could relax financial conditions, which is not what the Fed wants to see at this moment?
So we look at a broad range of financial conditions, and the stock market is simply one of them. I'm also looking at mortgage interest rates and borrowing rates for businesses and consumers for a variety of things. And I really do want those to remain tight and tightening as we go, because we don't want financial conditions to relax. We want them to remain tight so that we can continue to bridle the economy somewhat, take the accommodation out. Remember, financial conditions have been so loose in part because we were adding a lot of accommodation accommodation to get us through the pandemic. Now we want to pull that back, and we want the economy to slow, bring demand and supply back in balance, and deliver a sustainable growth path that delivers on price stability and full employment. This is achievable, but it takes some time to work its way through.
Mary, it's not the ideal scenario, but would you ultimately be comfortable or okay with triggering a recession, even if it's a mild one, in order to get over inflation?
Well, let me just say what is true is that I think about what I want to achieve, what Americans really are expecting us to achieve, and that is a smoother transition that doesn't require a recession, actually delivers on a slower economy that is still giving people the jobs they need and the price stability they deserve. That's what I'm looking for, and that's what I'm focused on 100%.
San Francisco Fed President Mary Daly speaking to Bloomberg about the outlook for rate hikes in September. Now, Sarah Hewin, chief economist for Americas and Europe at Standard Chartered, joins us now to give us her take. So, Sarah, we've had a slew of Fed speakers out saying pretty much the same thing. Inflation is the bigger risk than a recession. We're going to continue to hike. Don't think this is a head fake or that we're going to turn around and cut in 2023. But the market doesn't believe the Fed. Why?
Yeah, I mean, the market is clearly signaling that they're expecting the Fed to make a mistake, as in raising rates by another 75 basis points and then having to, or another 125 basis points rather, and then having to cut through 2023 and 2024. It's a very difficult one to calibrate, isn't it? We're in a situation where we have inflation well above target, some signs of enduring inflation, albeit others that suggest that inflation is past its peak, and at the same time, real strains on the economy. The employment situation is good as far as the payrolls report is concerned, but the weekly jobless claims are making us nervous. And we know that the jobs data are looking back in the rearview mirror rather than looking forward.
In terms of what you expect for the economy, how's it going right now? I mean, inflation is coming down. It looks like we're adding a ton of jobs. Unemployment is at 3.5%. Are we in a recession or headed for one?
Well, the data say that it was the data do say that we were in recession in the first half of the year, but we think that that's more of a technical recession because it's true that jobs were being added at a pretty solid pace all through the first 6 months of the year. Going into this half of the year, though, particularly as we get close to the end of the year, we're becoming more nervous that the cushion of savings that consumers have built up during the pandemic is fading. The squeeze on real incomes, we think, is likely to damage consumer spending. And if we look at where consumer confidence is at the moment, that in the past has been associated with consumer spending in real terms flat or declining. That to me sounds like a recession. So that's what we're anticipating really around the turn of this year and into the early months of next year.
Sarah, we're going to be getting the University of Michigan survey out later today stateside. We know how important that is for Jay Powell. He flagged that in one of his more recent presses. What are you looking for? Is there a specific number you're looking for? Are you gaining confidence that maybe the stickiness around inflation is starting to erode in the US?
We're certainly gaining confidence in that because if we look at what's happened to inflation expectations over the last few months, then they have declined. And it's a bit of a sort of crude rationale, but if we look at what's happened to fuel prices, the decline in fuel prices, and we know that that does have a big impact on consumer expectations. So the big number for us today is 1 year inflation expectations. If they get back to 5%, then that'll be the lowest that we've seen since February, and I think it will be quite a significant point.
But that's what worries me, is the fuel price component, because we know that there is such tight supply. The likes of Amrita Sen, Goldman Sachs saying OPEC Plus do not have the capacity to introduce more oil into these markets. China could come back in terms of demand, but you see a forecast, your 12-month forecast for Brent is that prices move lower. Just unpack that for us.
Yeah, absolutely. I mean, it's a supply and demand thing. So we're expecting weaker global demand, not necessarily from China, but certainly from the US and from Europe, to be one factor behind lower oil prices. Supply, we think, is better than many see at the moment. Inventories are doing well. Overall, we're expecting Brent to move back towards 90 or below over the course of the next 12 months. So that is going to drive inflation inflation expectations lower. It also is one of a broader story about input costs declining, and that gives us confidence that inflation is headed in the right direction.
Okay, so that's in the U.S., Sarah, and clearly oil has a bigger bearing. But in Europe, it is natural gas. It is an energy crisis that is potentially going to be exacerbated when part of the Rhine River becomes impassable today due to its water level. As we think about the inflationary pressures present in Europe, we also know that the growth outlook is deteriorating at a much more rapid pace. You had a negative GDP print in the UK revealed just today. How much room do the ECB and BOE have to hike relative to the Fed?
Well, ECB is pretty late to the game, so we think that they're going to be raising rates through this year and next year. By comparison with the Fed, we think that the Fed is near to done. We're expecting one more 50 basis point hike next month, and then that's it. For ECB, it's a tough picture. They're coming from a lower starting point, of course. They are worried about wage growth. The unemployment rate is very low, or a record low for the single market, and minimum wages are rising. So altogether, we think policymakers in at the ECB and indeed at the Bank of England are very concerned about wage pressures building, and that's less the case in the US. So for Bank of England and for the ECB, we think that they're going to be moving further over the coming months than the Fed.
And finally, just in the UK and for the Bank of England on the monetary policy side, how do you weigh the fiscal side of the equation? Potential tax cuts coming, depending on who ultimately wins the race to be prime minister.
Well, with Liz Truss ahead in the opinion polls and a very clear signal from her that she intends to cut taxes early on, I think that places more of a burden on the Bank of England to tackle inflation. So we would anticipate that they would be doing the heavy lifting when it comes to fighting inflation, and it may well mean that they need to continue with outsized rate hikes, certainly for the next month, but continuing to raise rates through to the end of this year at least. And that's in the face of their own forecasts for quite a prolonged recession starting in the fourth quarter. Our own view also is that the UK economy looks to be in trouble.
All right, and we saw some signs of that in the data this morning. Sarah Hewin, Chief Economist for Americas and Europe at Standard Chartered. Thank you so much. Coming up, Joe Biden is priming a re-election bid, setting up a potential 2024 showdown with Donald Trump. We'll have more on the latest from D.C. next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You are looking live at the Principal Room. Later today on Balance of Power, Kevin Rudd, Asia Society Policy Institute and former Australian PM. That is at 12:30 p.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Tom McKenzie in London. Now keeping you up to date with some of the developments out of Washington and Florida. Bloomberg has learned that President Biden is preparing to launch his re-election campaign in the months after November's congressional elections. That set up a potential rematch with Donald Trump. Those close to President Biden describe him as upbeat about recent legislative, economic, and foreign policy victories. Polls show most Democrats would rather have a different candidate. FBI agents reportedly searched Donald Trump's Florida home for classified documents related to nuclear weapons. That's according to the Washington Post. The newspaper says people familiar with the probe didn't say if the documents were recovered or not. Meanwhile, the former president has called, at least publicly, for the release of the search warrant into Mar-a-Lago. That heads off a public showdown between his legal team and Attorney General Merrick Garland. If you take him at his word, the Justice Department has already asked a court for the papers to be unsealed. Now a judge has to rule on it by 3 p.m. today. So the question that I have, Tom, is whether or not this warrant is really going to be released. I mean, Trump said go ahead and release it on his social network, Truth Social. But of course, he could release the documents himself, and his lawyers could also ask the judge not to release it, even though he put out that statement.
Merrick Garland, the AG, of course, saying he wants to see them released, so maybe a couple of days away. But what the details are, of course, will be important. The reporting from the Washington Post, remarkable around these potential nuclear documents, or at least nuclear weapon documents. Again, we don't know if it's US or other powers. And then the politics of this, reviving maybe the base for Trump as Biden looks himself to plan that 2024 run amid opposition within his own party.
Yeah, very interesting developments. Later today on Balance of Power, we're going to hear from Congressman Jim Clyburn, Majority Whip of the U.S. House of Representatives. That's at 12:15 p.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London with Matt Miller in New York. Tom Keene, co-anchor of Bloomberg Surveillance, of course, joining us now. Tom, Standard Chartered telling us a few minutes ago that they see Brent falling over the next 12 months. You're looking at oil in a historical context.
A raging debate into the weekend. All of a sudden, oil front and center. I like what Thomas Vargas said at PVM, where he said oil is attached to the equity enthusiasm. Julian Lee, writing for Bloomberg Opinion, goes the other way and really suggests OPEC will catch up with others and say demand maybe isn't all that great. What we know is we're priced on an inflation-adjusted basis like we were in the early 1980s. I've never said that. Let's look at the chart right now. This is one of the most famous charts off the Bloomberg. This is an approximation. It is Saudi Light, which is truly the world benchmark, adjusted for U.S. inflation going back to the first time Matt Miller listened to Disraeli Gears. And all you got to know is Richard Nixon, down you go on the right, and then up, OPEC, and the two runs up to the crash of 1986, and then bring it out over to the China boom, and up we go again. And we're really getting up to late 70 and early 80s inflation-adjusted prices.
Very interesting stuff. I think Disraeli Gears was far earlier than that, but we have a list of guests on your show, none of whom I believe were even around then.
Well, no, Wendy Schiller was far, far too young. She'll join us here on, of course, the moment that we're having with our judicial system and a former president, many others. Dennis Gartman to weigh in on natural gas. I think that's the sleeping thing of a lazy Friday in August. It's not a lazy Friday in August. Natural gas is on the move.
All right, Tom, we'll be watching the show for sure. We want to break some news, though, right now on China. Tom Mackenzie, what do we know about delisting U.S. companies based on their business decisions in China?
Yeah, so in the last couple of hours, or last hour or so, we've had a number of companies, including the likes of Sinopec, saying and announcing they're going to be delisting from their holdings. Of course, they're in terms of where they're listed stateside, in terms of those depository receipts. And part of this is going to be political, for sure. We know they've been wrangling between regulators in Beijing and regulators over in the US over the opening up or not of Chinese accounts. But of course, the geopolitics, and it's just worsened, hasn't it, in light of the Pelosi visit to Taiwan. So the Red Head Crossing Terminal, China says its company's US delistings is based on their business decisions, so pushing back on that political line. But it's hard to see how politics doesn't play into this.
All right, interesting development that we'll continue to follow for you. Let's look at what else we're watching. Very important to the markets is the University of Michigan consumer sentiment. We saw it fall a couple of readings ago to a 50-year low, and we're going to continue to watch this because if it climbs, it's just another sign that the market is going to be able to do better and will allow itself to climb, although I'm not sure if anybody's going to hold anything into the weekend, Tom.
Yeah, well, we know how focused Jay Powell is on this survey. On Russia, we're also looking out for GDP out of that country. Really interesting. Look, it could drop 4.7%. I think more interesting is what happens going ahead for this country, given it's deprived of some of those core pieces of tech from the US and others. That is it for Early Edition. More surveillance is ahead. Stay with us. This is Bloomberg.